discussing SiMSCI, the Singapore Index Futures, and Benny will be walking us through the techniques of how we can apply swing trading for the MSCI Singapore Index Futures. If you're new to trading or new to swing trading, do stay tuned because Benny will be imparting valuable tips and knowledge that you can apply for your trading. Benny has more than 15 years of experience in providing financial education to both institutional and retail clients, and her experience spans not just on futures, but she also specializes in forex trading as well. So, as usual, if you have any questions for our special guests, please type them into the question box and we'll address them towards the end of the webinar. If you would like to know where the question box is on your control panel, just navigate or somewhere close to the bottom, there'll be a question box and you can type the questions in there directly. All right, now before I hand the reins over to Benny, can I just do a sound check to verify if you can hear me clearly? If you do, please type yes into the question box. Thank you, Chi Kwan. Anyone else? Everyone? Are you able to hear me clearly? All right, thank you, HL Chan. Okay, Benny, if you're all set and you're all rigged up, over to you.
Hi, Sri. Thanks. Thanks for joining the session. Same thing. I just need to know whether you guys can hear me clearly. If yes, please type yes at the question box. Thanks a lot. All right, look, let's proceed with the session. Okay, so today I'll be talking about swing trading the SiMSCI, which is MSCI Singapore Index Futures. Before I proceed, let's take a look at the disclaimer first, and then I would proceed with what we're going to do today. All right. So today is purely educational. There is no financial advice. Okay, but towards the end of the session, I'll be going through live with you guys. How you can get started with trading the SiMSCI. Okay, so that's basically the objective. All right. Let me go through the agenda for today. Number one, if you have any question, right, you can type your questions at the question box. Okay, I will be able to answer your questions as and when. Yes, at the question box, right? Okay, let's type the questions there, or I will take the questions at the end of the session. The session is about 1.5 hours, so we should end at about 8:30 or plus minus around there. All right. Agenda for today, right? Number one, it's a introduction session into trading futures, okay, with the emphasis into trading SiMSCIs. All right, so number one, we're going to talk about the evolution of futures trading. How did futures get started, and all the basic things you need to know about trading futures. All right, from the terminology to the essentials. And specifically, I'll be covering on SiMSCI specific SiMSCI, but you could use the information to trade into any futures that you desire. Specific to SiMSCI, I'll be talking about then how you get started with SiMSCI, and especially if you are trading the Singapore stocks, okay, how you can use the SiMSCI to hedge into your existing stock portfolio. Now, this is especially important because we've seen the March period this year, all right, where there was a huge drop, and then because of the COVID and there was a recovery, then we start to see, for example, price moving up and down, right? So if you are holding, let's say, an existing stock portfolio and you don't want to sell, then how can you use the SiMSCI, which is a derivative product, to hedge into your existing stock portfolio? All right, then lastly, I'm going to give you a comprehensive, or rather not comprehensive, not in detail, but really more on a comprehensive idea on what are the swing trading methods that you can explore on. Myself, I will cover in depth on the divergence trading, which I will show you exactly how to do that in the live session later on. And of course, then we're going to look at some one recording of the SiMSCI that I did, and as well as to take a look at the live charts. Okay, same thing, if you do have questions, please ask me at the question box. If I can't answer, I will take that questions towards the end of the session and answer that. All right. Okay, now let's talk a little bit about myself quickly. This photo might not look like me. I think that I spoke to many of you guys. This photo is the bigger version of myself. All right. But I've been doing the training for many years already. I think it's really more than 15, probably coming to 20 years. Right. In the recent years, I'm doing a lot of consultation on programming, and as well as to focus into the trading, and slightly lesser in education, because I retired or semi-retired for a few years, and I started to train a little bit more this year. All right. Myself, I'm doing a lot on the forex and the commodities and the indexes trading. For equities, mainly my Singapore portfolio composed of REITs. Okay, that's for income. Okay, but I'm also doing a lot of the growth portfolio in the Hong Kong and the US market. All right, forex and the index trading, which is also the SiMSCI, they are my bread and butter, meaning that when there's opportunity, I'll be there. All right. I'm doing also a lot on AI development for my clients, so a lot of quant trading methods, and mostly dealing with price action, projective analysis, and how to merge into a complex systems of trade management and money management. All right. So today the focus would be on futures trading. Okay, so let's talk about the evolution of futures trading. What exactly is a futures contract? All right, so futures contract is why is it called futures? It's a contract that's between the buyer and seller of a product. Usually that product is a raw product when it first started. Raw product means that, for example, if you're a farmer growing corn, sweet corn, and then or a farmer growing, let's say, barley, you want to trade this, and it's being used in the olden time for all these raw material. All right, but now we also apply futures for financial products such as indexes and also the treasuries or currencies. Okay, so let me just explain the futures contract from the perspective of a raw material, and we assume that today we have a buyer and the seller is a orange farmer. That means he's a farmer growing oranges. All right, the buyer, she is a manufacturer, so she manufactures orange juice, right? And therefore the orange juice that she manufactured would be delivered and we will buy that. All right, so the seller is an orange farmer and the buyer is someone who is making orange juice. Okay, now, so the buyer and the seller agree to buy a product, and the product will be oranges at an agreed price right now. Okay, they agree at the price and the terms right now, but instead of having the oranges to be delivered at current moment that's being agreed, all right, usually we would agree a price, and then we will have that goods or items being delivered to us as soon as possible. All right, but no, for the futures contract, they agree to deliver at a later date. All right, why is it that they want to do that at a later date? Now that's because each of them has an objective. But before going into the objective, what was being agreed on currently is that the seller, who is a orange farmer, they agree to sell oranges to the buyer, and the buyer agree on certain terms, such as, for example, last 2 months ago, they agreed that on the 29th of October, they will sign a contract, and the contract is to buy 1,000 kg of oranges, all right, at $1 per kg from the seller, and thus, because they agree on a contract, right, the seller will supply 1,000 kg of oranges to the buyer. Okay, however, all right, the deal that they made is not to deliver right now when the deal was being made, was to deliver at a later date, which, for example, on the 28th of December. Okay, now, why is it that the buyer, she wants to strike a deal at a earlier date? Okay, that's because the buyer is trying to hedge the risk. Okay, why is it that she is interested to hedge the risk? Perhaps that she has certain knowledge to foresee that the price of the oranges might go up. Okay, because maybe that she has special knowledge about the weather, and the weather forecast in the next 2 months will not be good. Okay, thus could potentially affect the supply of oranges, and thus, right, the price might go higher, right? So she doesn't mind to strike a deal right now to hedge her risk, okay? But the idea is that she doesn't need the good at this moment that she signed that transaction, that deal, okay? She wants that to be delivered at a later date, okay? So that's the key idea here, where she wants to go into a futures contract. All right, then why is it that the seller, the orange farmer, he also doesn't mind to agree on a deal at the earlier date? That's because he also wants to hedge his risk. Okay, what kind of risk? Perhaps that he has special information to say that, hey, look, there might be an oversupply of oranges, because last year, all right, many farmers entered the scene and planted new trees, and this year they're going to have oversupply of oranges. All right, so if there could be an oversupply of oranges, then price might be moving down. So therefore the seller doesn't mind to sign the agreement right now. However, the oranges will take time to ripen, so therefore he agreed to deliver perhaps 2 months later. So agree right now, all right, deliver in the later date, but they sign a contract, and that becomes the futures contract when it first started. Okay, now in the modern days, then we take this futures contract because there's still time between the actual signing to the actual delivery. So people take this contract and they trade that. Okay, so for example, they can take this contract, and maybe that there's a typhoon going on and prices of the oranges already move up. They can take this contract and say, hey, look, I have this contract signed at $1. I'm going to sell to you at $1.50, and you can take this and you claim your oranges, right? So, and people don't mind that, because perhaps right now the price of the oranges is moving to $2 per kg. Okay, so that's how the futures contract is being traded. However, more commonly to us, we will be trading into the financial futures, okay, because then we don't have the physical delivery. Imagine that you are trading into the commodities futures and you need to deliver oranges, you need to deliver gold or copper, or for example, soybean or oil or pork bellies, right? So then we are right now evolving into trading the financial futures, such as, for example, to trade into the index futures, okay? For example, SiMSCI, all right? So that's the Singapore index futures, all right? Or even you have the single stock futures, such as to trade into DBS or Wilmar futures, the currency futures, for example, the Euro futures, all right? The interest rate or the treasuries futures. Now, all these financial futures, they don't need to have physical delivery, but instead they will go for cash settlement. What's cash settlement? It means that if you make a profit, you will take a profit. If you make a loss, you will pay a loss. Okay, that means that the money will be deducted from your account. If you make a profit, you will see money inside your account. All right. Okay, now, so we know the evolution of futures trading, and many people want to know, for example, the terminology in future, because they find that it's a little bit difficult to understand. All right, so what I'm going to cover here would be the terms that you need to know, and in fact that they are really very comprehensive. They are all there already on the terms that you need to know about trading futures. Okay, you can take this understanding and apply that to any futures contract. Now, number one, all right, very important, just to let you know, is that futures contract is an exchange traded product. Now, why is it important to have exchange traded product? Again, all right, the key thing is to eliminate counterparty risk. Okay, who is your counterparty? The counterparty will be the person that you trade with. Okay, in this case, all right, if you are trading a futures contract, then because it's exchange traded, your counterparty would be the exchange. All right, so why is it important to have the counterparty being the exchange? Because the exchange will also guarantee that the contract is being honored. Okay, therefore you will eliminate counterparty risk. Now, every exchange traded futures are essentially cleared. That means cleared by the exchange. Now, this means that when a futures contract is being bought or sold, the exchange becomes the buyer to every seller and the seller to every buyer. So these will greatly reduce the credit risk associated with the default of a single buyer or a single seller. All right. Now, I think that I have to bring this up because there's always a question. The question would be, for example, what's the advantages of trading a futures contract versus a CFDs? Okay. Now, CFDs is what we call over-counter OTC. That means it's over-counter type of product. Okay. When you have over-counter type of product, right, essentially you are trading, All right, that means your counterparty is a single party who is the broker itself. Okay, so if anything that happens to the broker, then you might stand to lose, you might have some losses, because then something might happen to the other party, which is your counterparty, that's the broker. Okay, now when you are trading, for example, a futures contract, the specifications are clearly laid out. For example, if you are doing, let's say, oil contract, so if you need to deliver the oil contract, the oil, then it will tell you what's the volume to deliver. Okay, so if you are trading, let's say, orange or orange juice, then what's the weight? All right, or you are trading the financial products, then the terms are standardized, whether you are trading only one contract versus someone who is doing 500 contracts at one point of time. Okay, now just to let you know is that the futures contract has a contract month or delivery month. Okay, this means that every contract, if you take a look at the right hand side, every contract has an expiry month. Okay, so for example, right now it's towards the end of December, so people, traders right now will be trading the December contract, but towards the end of the December at a fixed date, right, this contract will expire. Okay, and then we will move to trade into the next month, which is January. All right, now because of this, because of the expiry every month or at a specific date, there would be the need for settlement, okay, based on the value of the contract. So the settlement could be physical or cash settlement. And for the purpose of today's session, I'll be focusing on SiMSCI. Therefore, all the settlement will be on cash, meaning that if you make a profit, then you will see cash inside your account. If you make a loss, all right, the cash will be deducted from your account. So that's called cash settlement. All right, let's move on. Now, the good thing about trading the futures is that you can trade in any direction. Okay, for example, if you like to buy, if you think that in the future price might be moving up, all right, so you like to buy, so we call this term called long. Okay, we long a specific contract. All right, so when you long a specific contract, all right, you will make money if that contract value will increase in the future. That means that if you were to buy right now at 100, in the future it moves to 110, that's where you can make money. Okay, now if you are bearish, for example, you think that the price is likely to move down, then you like to go short. Now the term to sell, all right, is to short. And in the futures contract, you don't need to own anything to sell. Okay, and you are not selling naked as well, all right, because you can trade freely in either direction, either to go long or either to go short. Right, you will make a profit if the value of the contract decreases. Okay, meaning that, for example, if you were to go short right now at 100 and in the future it moves to 80, then that's where you make money. All right, now if you take a look at the right hand side, I have a table here, and the table says that if you were to go, if you have the bid price and the ask price. Okay, the thing about trading the futures is the same as buying or selling stock. You always be buying at the ask price, which is the higher price, and you'll be selling at the bid price, which is the lower price. Okay, as of stocks, equities, you could trade at market, or you can queue to buy at limit. Okay, that means that you can queue to buy at a lower price. Okay, so it's literally the same as doing equities. All right, now the difference between the bid and the ask, that would be the spread. Okay, so the spread will be essentially your cost of trading. The lower the spread, the better it will be for you. Okay, of course, that when you talk about the cost of trading, there are also other costs involved, such as the brokerage for cost, commission, etc. But the basic raw cost you're looking at would be the spread, all right? The spread between the bid and the ask price, okay? Just remember, every time when you buy, you always be buying at the ask price, and every time when you sell, you'll be selling at the bid price. The difference will be your spread. Now, let's take a look at every time when you have a futures contract, there will be this contract specification, all right? And then they will list down the currency of transaction. So the currency of transaction will be different. For example, if you are trading SiMSCI, the currency of transaction will be SGD. Okay, if you are doing Hang Seng indexes, then there will be Hong Kong dollar. If you are doing, let's say, the Dow or the Nasdaq, that would be in USD. Okay, so when you open an account, a brokerage account, you always have a base currency. Okay, base currency, you can define the base currency. Many brokers offer USD, but when you trade that specific, let's say, contract, your profit and loss will be converted real time or at a fixed rate, right? Based on your a rate, right? And that profit and loss will be converted between the different currencies. Okay, so for example, if your base currency is USD, all right, and you're trading the SiMSCI, so they will take the dollar Sing conversion and convert that. I think that there's also questions such as, will there be a lot of losses every time you go for conversion? Don't worry, it will be minimal. Okay, it won't be a lot, because then when they convert, usually will be at the spot rate. Okay, at the current rate. All right, now if you take a look at the contract size, why is it important to know about the contract size? That is essential for the hedging, but that is essential also for the calculation of the margin. Okay, margin, I will talk about that later. If you take a look at SiMSCI, the contract size would be a multiplier, which is 100, right, times the index. A lot of futures contract, they will let you know what's the multiplier. All right, for SiMSCI is 100 times the index. These will give us an important clue on what's the minimum tick value. Tick value means that every time when price move up or move down, what is the minimum change? So for the SiMSCI, the tick value is 0.05. So when price move one tick, you will know that it moved by 0.05. Okay, if you are trading one contract for the SiMSCI, all right, then a per tick value for one contract will be $5. Thus, 1 point movement will be $100. Right, so this means that when price move from 295 to 296, okay, that's 1 point movement, that would be equal to $100. All right, if you were to trade one contract. So if you trade, let's say, for example, 10 contract, 10 times 100, all right, so a 1 point movement for 10 contract will be $1,000. All right, okay, now price limits. You realize that this year, and the year really goes very fast. We start with the COVID, and we start to hear about price limit in the futures contract for the Dow, for example, and then price hit limit, right? In March this year, when price was very volatile for the indexes, right? Maybe you will hear from news that particular index will limit down. Okay, so this means that because for the futures, there is a maximum range permitted for each trading session. Okay, maximum range. All right, so when you hit that maximum range permitted, the market will go limit up, limit down. It will pause for a while, it will stop for a while. All right, and then basically to cool down, and after that it will reopen, and then the price limit are calculated again, and different contracts will have different limit rules, right? So I don't really see that the futures contract get into limit orders, right? Limit rules, okay, or hit the limit unless there is really a special, very volatile situation. Okay, now one thing about the futures contract, and that's really the good thing, the reason why many people likes to trade the futures is because it's a leverage instrument. Now remember, leverage is a double-edged sword. Okay, so I explain why is that so. Number one, for the futures, because it's a leverage instrument, it will require margin. Margin means that it's a collateral for you to deposit with the counterparty for you to get started in the futures contract. All right, now in the futures, there are mainly two types of margin. One would be the initial margin. Initial margin means that the minimum, which is the basic amount, minimum amount of deposit you need to put inside your account, okay, in order for to start a new position. Meaning that, for example, you need to put this money inside so that you can open a new contract. Okay, so after you have opened a contract, then we need to fall back to the maintenance margin, which is the minimum amount that you have in your account, all right, before it will result in a margin call. So you need a X amount to start trading on a contract, all right? And after that, price will move up and move down, right? So at the end of the trading day, right, the broker will calculate an amount and say, hey, look, your amount that you have in your account does not meet the maintenance margin, and therefore you will result in the margin call. So once you top up money, all right, top up enough money inside your account, you will bring the margin back to the initial margin, and that's okay already. Now, if you don't have enough money to top up your account, all right, then it will result in the margin call, and the broker will have the right to sell your contract, right, to minimize the loss. Okay, don't be scared about this, all right. Usually they won't sell immediately. Okay, they will call you to top up the margin. Okay, now why is it that many people likes to trade the futures? A lot of them will do it for hedging. Okay, because then if you take a look simply by looking at the equities, if you have a portfolio of equities and sometimes you don't want to sell, there could be many reasons. It could be because that 2 weeks later you're going to receive dividends. You don't want to sell, but then going forward, you foresee that the market could be dropping, and thus you would like to use the futures contract to short the index to hedge your existing portfolio. And because that is very easy for you to open a sell for the futures, so therefore a lot of people use the futures contract, and also because it's very liquid, right? Because the counterparty is your broker, thus many people use the futures contract for hedging. All right, now when you get into the hedging, you need to know especially the contract notional value, meaning that what is the value of the contract you are trading. All right, so the contract notional value would be a multiplier, all right, times the futures price, and we will go into the calculation later when we enter the hedging part. Okay, now this mark to market has to do with your maintenance margin. Okay, now the mark to market is a final daily settlement price, okay, which the exchange will set that every day to calculate, so that we know whether your margin is enough. That means that whether you have met the requirement for the maintenance margin. Okay, the mark to market price is same for everyone. Okay, so this means that after you have traded, at the end of the day, all right, at a fixed cutoff time, okay, there will be a mark-to-market price, and thus we will be tallying your daily profit and loss, all right, and we will make adjustment accordingly. So this means that no loss are carried forward. This also means that no one will be able to hide the losses. Okay, so this is also good because then you get track on your ability to carry this trade to a later part. If you can't and you fall back to the maintenance margin, we will know immediately, and then we don't go into extreme huge losses. All right, so this is the concept of mark to market, and it ties with the maintenance margin required. All right, now regarding the futures expiry, so for example, specific to SiMSCI, there are two things that you need to note. One would be that for the SiMSCI, you have the last trading day. The last trading day is the last day you can trade that contract. Okay, so after the last trading day, the contract will expire. Okay, so expiry is the day after the last trading day. So a lot of people are scared to say, hey, look, well, because the contract can expire, will I stand to lose all my money because it's already expired? The answer is no. Okay, because then you can have three options prior to expiry or even after expiry, right? Things can be done. So number one, before expiry, you can choose to offset the position. Okay, what is the meaning of offset position? Let's say, for example, you are long, you bought into a contract, right? You are long SiMSCI. Okay, nearer to the expiry, you decided that, hey, look, I need to offset the position. So when you're long, what do? You square your contract, you square the contract by because you previously are long, right? You square the contract by selling it. Okay, you sell that long contract. Okay, now let's say, for example, you decided that, hey, look, I am short right now. I'm short SiMSCI. Okay, and the current month is going to expire, but I think that the short is still good to carry on. Right, so what you can do, instead of just offsetting your position, you can do a rollover when it gets nearer to the expiry date. Okay, so rollover means that you offset your current position and you establish a new position in the next contract month. Okay, but you can do it yourself, or you can ask your broker to help you to do the rollover procedure. Okay. Lastly, you can do they will do a settlement if the contract has already expired. Okay, say for example you have a contract which is to long the SiMSCI and you forgot all about it. All right, but don't worry, it won't go to zero. They will have a final settlement, all right, price of this contract, and they will calculate whether you make a profit or loss. And if it's a profit, then money will be put inside your account. Okay, so 3 options when it's prior to expiry. All right, and to repeat, you won't lose all your money. All right, okay, now let's talk about volume. Now in the futures contract, we have the volume concept and we have the open interest concept. Okay, volume is very different from our understanding, all right, of the equities, meaning that volume in the futures is very different from that volume in the equity side. All right, so what is the definition of volume? Volume will be the number of contracts that have been bought or sold in a given time, and volume is useful for us to know, for example, when you need to roll over or when you need to move to the next month. So usually when the contract is near to the expiry date, right, the volume will decline quite drastically as the current month contract gets nearer to the expiry date. Okay, so you will let you know that, hey, look, it's time to move on to the next contract already and stop trading the current month contract. All right, and at the same time, the volume is also a telltale sign, or rather, it's more active, meaning there's more volume trading in the contract when the cash index is trading. Now, right now, for example, the cash index is closed, then we start to see that actually the SiMSCI futures contract, the volume starts to decrease, and the volume will move to the, for example, next market, which is the Dow Jones or the US market, because that's where the next market is opening soon. All right. Now, therefore, when you see a spike in volume, all right, for the futures contract, it doesn't mean that there are a lot of buyers and price is likely going to move up. It doesn't work this way. All right. So what's more important in the futures contract is that to note this term called open interest. Now, what's open interest? Open interest would be the number of contracts held by market participants at the end of the trading day. Okay, so for example, I have 3 persons here, right? The first person bought 5 contracts. The second person bought 10 contracts. So they bought in total right now, what they're holding right now, all right, will be 15 contracts, regardless of whether they are long or short. All right. Now, then the other person, the third person, actually, they sold another 10 contracts. So it doesn't work this way by taking 15 minus 10. No. In the open interest, we will take in total what the number of contracts that are currently open. That's 25 contracts. All right. Now, what does open interest tell us? Open interest actually tells us whether there's more money flowing in this particular at this particular moment into the futures market, into this particular contract. Now, when you have more money flowing in, it shows that there are more people who are interested to participate in this particular movement. Thus, for example, when you see that price is showing a very strong trend, and then you see that the open interest of this particular contract on a very strong trend is actually rising. So this means that more people are pumping in more money to participate in the rising trend. All right, then you are suspecting that the trend can continue on. However, as price starts to move, and then you start to see that the open interest is actually declining. This means that less people are participating in this particular trend. Thus, there's a high chance that the trend is losing strength. So this is the use of the open interest, and the exchange will publish the open interest data in their website. Okay. Now we actually completed the beginners 101 on what futures trading is all about, meaning that when you take a look at the exchange leaflets, right, listing out, for example, what is this futures contract about, and once you know about all this terminology I explained just now, actually you can start trading the futures contract. You understand most of them. Okay, so later I'll be showing you, for example, one of the contract specification from SGX on SiMSCI, and you realize that all these terms are all there. Okay, now let's take a look at the SiMSCI. So what is SiMSCI? Is the short form, or rather we always call that SiMSCI futures, or short form for SGX MSCI Singapore Index Futures. Okay, the product code is SGP. Now, if you take a look at the SiMSCI Index, so the SiMSCI futures is based on the SiMSCI Index. Okay, so the SiMSCI Index is made up of 22 stocks as of July 30th, but right now only 21 because of the integration between the CapitaLand Commercial Trust and CapitaLand Mall Trust, and then we have the Kappa DC being incorporated into the STI constituents. Okay, now so therefore the SiMSCI, all right, is now made up of 21, but as of July 30th is 22. Now, if you take a look at the right-hand side, so these would be the component, okay, component of the STI index, okay. Those stocks highlighted in yellow, they are belonging to also the SiMSCI index. So therefore, you can see those that's in the STI index. Okay, a lot of them or most of them in the SiMSCI, except for one only, which is Suntec REITs. Okay, Suntec REITs in the SiMSCI, all right, but Suntec REITs not inside the STI constituents. Okay, well, what this says is that there is a high correlation of SiMSCI index to STI. So usually when the cash market moves, all right, you likely going to see that the SiMSCI index will also move accordingly. Okay, all right. There's one question here on the volume, on the trading of futures. Does it mean that when we trade futures, you can ignore the volume? Yes, you can do that. You note the OI will do, okay, which is open interest. All right. Now let's take a look at the contract specs of the SiMSCI futures, meaning that, for example, when you want to trade, let's say the SiMSCI, all right, the exchange will publish something, right? And that something will looks like this. Okay, so it will tell you, for example, the SiMSCI futures, right, is the code is SGP. Okay, as I mentioned, different futures contract will have different pricing currency. So the SiMSCI would be SGD. Okay, now the trading hour for the SiMSCI, it is slightly different from the cash market. For the futures traders, we need to work a little bit harder earlier as well. The trading hours would be 8:30, half an hour earlier than the cash, and then it will end at 5:20. Okay, now I see these as a benefit because then yes, we need to be in the market earlier, but if there's anything that happens before the cash market opens, right, we can do something to the futures market already. So we have half an hour of potentially insight. Okay, and then of course there we have the 20 minutes where the futures market is trading also, and then cash market close at 5, and then we have 20 minutes of extra that we can do a bit of a hedging adjustment, etc., to the via the futures contract. Okay, now we also have the T+1, which is the extended hours. So for example, the extended hour would happens at 5:50 to 5:15 a.m. Now that means that right now the SiMSCI futures is trading at the moment. Okay, it is still trading at the moment. All right. Now this is good as well. So for example, if there's anything that happens to the overseas market, let's say for example another 911, we hope that it doesn't happen, but let's assume that if there's another 911, right, the market, the US market will have reacted. And because if you are not trading in the futures, you are only trading into the cash, you have to wait until the next day, all right, when the cash market opens, then you can react, you can do something about it. All right, therefore, if you are already trading into the SiMSCI, then you can use the SiMSCI already, all right, to do something, for example, to hedge into equities position before the cash market opens. Okay, so this is one of the benefit of the extended hours of trading. All right, so the contract listing would be 2 serial and 4 quarterly months. Wow, it's a little bit difficult to understand, but then don't worry. when you are trading with your broker will list down all the different contracts for you. They will tell you that, hey, look, the next contract you need to look at will be Jan, and then you have the February, and then you have the March, for example. All right. The contract multiplier, just how I mentioned, the contract multiplier will be 10. Thus, to know the contract size, which is the notional value, will be 100 times the futures price, would let you know what is the contract size. And that's important for you to calculate in your hedge ratio. Okay, should you want to use the futures to hedge your stock portfolio. All right. Now, the minimum fluctuation will be 0.05. So I mentioned that would be per tick. Okay, per tick for the SiMSCI on a one contract will be equal to $5. So every fluctuation on the screen will be 0.05. Okay. All right. So let's take a look at the next one. The last trading day will be the second last business day of the expiry contract month. Okay. So usually you will know that from the volume. All right. You will know that the volume drastically will decrease, all right, when it's very, very near to the expiry date. Okay, settlement, cash settlement, final settlement price. Okay, the method, right, which is known to everybody, but then the exchange will calculate that. Then this is the daily price limit. Okay, and that's all. These are really not very important for the retail market. So that's really for the large trader. Right. Okay. Now, if you take a look at the weightage of the SiMSCI, all right, the weightage, you can see that on the 3rd of November, the top three banks, okay, DBS, OCBC, UOB dominates. All right. Even until now, SiMSCI, all right, index, it has the MSCI kept increasing the weightage of the bank. Right now, the weightage of the bank is near to 50%, okay, about 47%. All right. So it kept increasing the weightage of the bank. This means that if you like to, let's say, trade the bank, or you like to profit from the movement of the banks, so instead of buying into the bank, you can consider to buy into the SiMSCI. Okay, so the benefit would be, for example, if you are involved in the bank, you need to come up with a large amount of money, the full amount of the money. So if you are doing the SiMSCI, remember the SiMSCI is a leverage product, then you just have to come up with the margin only. Okay, so which is a small amount of the full contract. All right. Now, just to further understand more about trading into the SiMSCI. So number one, if you want to get started in trading SiMSCI, you need to know what is derivative trading, because derivative to a certain extent is different from the equities. All right. I believe that I've covered quite comprehensively the basic of what you need to know about derivative trading. Okay. Then number two is, of course, to open an account. The good thing about opening an account with the futures brokerage house, for example, if you want to open an account with Phillips, right, you don't need any maintenance fee. You don't need to come up with a sum of money. All right, so you can just open an account and then try it, or to get the demo account. All right, so this can be done. Usually the broker would supply you, once you open an account, you have a trading account with them. The charting tools will be inside as well. Okay, and then you have a trading platform that allows you to put in the different orders, such as to trade market orders, or to put in the limit orders, or some other slightly more complicated orders. Okay, and they also be providing education like what we are doing right now. Okay, now more important is the margin requirement. The margin will change as the contract notional value changes. So for example, as of 3rd of August, okay, the maintenance margin for SGX, for SiMSCI, okay, the initial margin will be 2,200. Okay, the maintenance margin will be 2,000. Okay, so for example, the brokerage house, which is the brokerage that you're dealing with, all right, they might be asking for a little bit more than the margin requirement from the exchange, so that we don't really get into margin call very easily. all right, and also that it's just a slight amount, but this margin will keep on changing as the index, as the notional value keep changing. Notional value will change if the index increase. So for example, when I was preparing this on the 3rd of August, the index, the SiMSCI was trading at 275, but right now SiMSCI is doing at 325, for example. So that it will change in terms of its notional value, and thus the margin will change. Okay, now so let's since we are into the the hedging, and we are into the notional value, let's talk about hedging. Okay, as I mentioned, that futures is commonly used as a form of hedging instrument, especially for the big players out there. Okay, so for example, let's assume that this is the chart of STI and you bought in somewhere around here. So that's a nice low price you bought in, and you just happen to buy in a lot of banks. All right, now moving forward, price reach a high point, and you think that this high point is a key level and price might be dropping, but you don't want to sell your portfolio of banks. Why is that so? Perhaps that two weeks later you're going to receive dividends. It's going to go XD. Right, you've been holding this for quite some time already, and you don't want to sell it. So what can you do then? So you can use the SiMSCI to hedge your existing stock portfolio. So for example, here you bought in the stock, you are long stock. Okay, so how to hedge? All right, so you have to short the SiMSCI. So because that instead of letting price come down, right, you decide to short the SiMSCI, so that if you short any price movement that comes down and be lower than your open price, that becomes profit. In the end, it compensates for the loss in value of your equities. Okay, so let's take a look at then if you have, let's say, a certain portfolio of equities. Okay, so what is the number of contract you need to open? Okay, so we need to know, number one, the contract notional value, and then with this we can calculate in a hedge ratio. Let's assuming that the notional value of the SiMSCI futures, the current transacted price is about 295. Okay, so the notional value would be to take the multiplier, multiply by 295, that would gives you the contract value of 29,500. All right, now assuming that you have many banks, and that exposure will be somewhere around 120,000. So you ask yourself a question, right? So how many SiMSCI contract must I open in order to hedge my stock exposure of 120,000? So we work by this formula here, right? We take the value at risk divide by the notional value, will gives you the hedge ratio. So 120,000 will be the value at risk, divide by 29,500. All right, that will give you about 4. Okay, 4.06. Thus, in order to achieve a hedge, you will open approximately 4 contracts. All right, now this number is an easy number because you can round it down easily. But what happens if you have 4.58? Okay, so it's a tough number, because 4.58, you can round it down to 4, or you can round it up to 5. So that the question will be, do you want to under hedge your position, or you want to over hedge your position? Now this really depends on your own profile. Okay, some people prefer to under hedge, because then they say, hey, look, I just want to make sure that during this downtime, potentially the index is going down, thus my stock, which is very highly correlated with the index, might be moving down. I just want to hedge that. So I don't want to have an overexposure. So if you don't want to have overexposure, thus you would be opening 4, all right, instead of 5. But some will say, hey, look, I may as well open a little bit more. So if it really comes down, I have the stock as a backup, but my short can make me more money, because instead of opening 4 contract, all right, open 5. So I have a little bit more, that becomes my extra profit. Okay, so it really, the answer is really based on your profile. So you have to answer whether you want to over hedge or you want to under hedge. All right. Okay, now we talk about the hedging, we talk about the terminologies. Now we're going to talk about the trading method. Now, in 1.5 hours, it's very difficult to cover many trading methods and in a very detailed way. So what I did is I just let you know roughly which are the trading methods, and then you can explore that, right, further. Okay, so number one, if you take a look at the trading objective, okay, some people will want to trade the futures or be involved in the futures trading because of hedging. So we talked about that already. Now, some people might want to use it for speculation, simply because it's a leverage product, so you don't need to have a lot of money. So imagine you want to trade a contract of 30,000. You don't need to come out with 30,000. You come out with a fraction of the money to start trading it. Okay, so this also brings to people who wants to take a position. So for example, if they are bullish on let's say generally the index component stocks, or generally they are bullish on banks, instead of coming up with a huge amount of money to buy the banks, all right, then they can use the SiMSCI, all right, to use it to take position, meaning that instead of trading directly into the banks, okay, they can use a SiMSCI because of the high correlation to buy into the SiMSCI at a fraction of the full value, because it's a leverage product. You just have to make sure that you put in enough money for your margin requirement. Okay, now in terms of trading profile, tasks, because of all these different objectives, there will be different trading profile. But many people who are trading, okay, especially the retailer, we are mainly into the scalping, the intraday, and the swing trading. Okay, scalping would be a profile where really you are going in for a few ticks. Okay, each time you go in 3-4 ticks, but you will enter a large number of contracts. So I know that there's a group of traders, every time they will do like 3-4 ticks, but each time their contract size is about 20, 30, or even 100. Okay, they don't work for long. As in every day they don't work for long. Once they go in, they scalp enough, and then they will come out, and then they'll do their things. All right, so that's the scalping, but make sure your size is huge. Okay, some will do intraday trading because of the high liquidity, because your counterparty is the exchange, right? The high liquidity, then, and also because of the range, and also because that you can do both long and short. So a lot of people wants to do intraday trading, meaning that I open the position in the morning, for example. Hopefully a few hours later, I can exit the position and then I make my profit, and that's it. Okay, some people would like to do intraday trading, but today I'm introducing the swing trading, because for swing trading, it means that you can be on the intraday profile if the price move fast. Meaning that, for example, you open a trade in the morning, hopefully if it move a lot, then you can close the trade in the afternoon already, or before the market close. Or you might want to hold this particular trade overnight and then wait for next day or 2 days later. Basically, swing trading is a middle ground to intraday and to holding a position for a few days. Okay, and lastly, of course, to take position. All right, now these three profiles, scalping, intraday, swing, will requires you to read to the lower time frame, usually to trade in what we call multiple time frame, meaning that you need to go to the lower time frame, such as 5 minutes, such as 30 minutes, or even a 60-minute chart to trade that as well. Okay, so let me just show you a 30 minutes chart on the SiMSCI. It looks like this. All right, so this is a 30 minutes chart. Later I'll be introducing a free charting platform, which is under investing.com. But should you like to have a trial on SiMSCI, you can open the trial from Phillip Futures, and they will let you see the chart as well in the platform. Okay, or you can open an account, and then you'll be able to see the streaming prices of the SiMSCI and the charts, and also the tools inside the platform. All right. Okay, now if you are using the investing.com, later I will show it to you. Then remember to adjust that to the Singapore time, GMT +8. Okay, Singapore time. Otherwise, you're going to see some weird timing there. All right. Just to let you know, because it's a free platform, thus every time when you log in, right, you have to make the adjustment all over again. So if you can try to get a platform from the brokers, then things will be safe there. Okay, so let's talk about the method. Few methods I like to cover. All right, just really to let you know what are the methods out there. Number one, for the futures trading, especially the SiMSCI, right, we use a lot of price behavior. So such as, for example, we use the support resistance, we will do breakout, or we do range trading. We also have like use candlestick, chart pattern, or just purely sentiment. All right, what do I mean by purely sentiment? Remember the group that I told you who are trading scalping. All right, so they have very simple method. If price is above the opening bar, for example, they will do long, and then if the other side, they will go short. Okay, so some sentiments based type of indication. Or you can be looking at a trend based. So for example, you can use a moving average, or you can draw trend lines or channels, or some people who use Fibonacci or harmonic. All right, later I'll be showing you how to use the Fibonacci. Okay, so this is something that's very useful. All right, okay, so this is, for example, a 15-minute chart. Okay, so this 15-minute chart, what happened is that at that point of time, SiMSCI is heading down. So what I did is I drew in a trend line here. So I drew a trend line, just hit the resistance. So price in the morning, in the first opening bar at the first 15 minutes, right? Price actually move up. Okay, was quite bullish. So it moved up. Who knows that it hit into a resistance, cannot sustain, and it actually closed below the first opening bar. Okay, so remember I told you about this group of traders, huge pros. All right, so what they are doing is that they just rely on the first opening bar. Above they will buy, and below they will sell. In fact, that then this was the point that actually they sold, and it's moved nicely and into the profit, and then they close the trade for the day already. Okay, so it can be as easy as that, or whatever method that you are using for your own stock investment or trading. Okay, the only thing is that you need to use the lower time frame chart. Okay, that is something which I recommend. All right, so after that movement down, price enter into the T+1, which is the overnight trading, and then it moved into the range. So you might want to do a range trading. So buy low here, range trading, and then to short high here. Okay, or you might want to use the moving average. This is good if the movement is trending. Okay, it doesn't work very well if it's not trending. Okay, so for example, 2 weeks ago we had the SiMSCI and STI moving up very nicely. So that's a trending movement that's really moving very nice, and thus a moving average method will work very nicely then. But if the market is not trending, is actually in the range, then the moving average doesn't work very well. Okay, so another method which is underpriced and very common for the futures trading, for the futures group of traders, is the use of Fibonacci or some form of ratio analysis. Okay, so what I did is that you can see the futures is moving down very nicely in a trend line, a resistance. All right, so you want to know whether this movement up, right, is near to a strong resistance for you to sell. Okay, so what I did is I drew in a Fibonacci ratio here. From the high to the low, price retraced by 62%, the golden ratio near to the 62%, hit into a trend line resistance and then look for a signal to sell, and that's a very nice move here. Okay, so that's one of the method. All right, now the other method which I want to cover more in depth is actually the divergence, using the divergence trading. But the reason why I wanted to move more in depth to this is because that when you use the divergence trading properly, you can get into a trade that's either with the trend, or that's either trend reversal. It's a little bit complicated here. All right, so I have another course running with the SGX Academy, and that's free of charge. That's talk in detail about divergence trading. So when the schedule is out, you can register for that. Okay. So let me just show one of the trade on divergence trading. So price has been moving down. All right, moving down in a downtrend. Because of certain reason, we start to see that in a downtrend that there's this bit of a up movement. Okay, so the question that we ask ourselves would be, when price move up in this manner, is this a genuine up, or it's just what we call a temporary stop, right, to the downward movement. But in fact, that it is just garnering more people to sell here. Okay, so this is the purpose of what we call with the trend divergence trading. Okay, so we can see, for example, there is a bearish divergence here. Why is that so? Price move higher. So you can see that in this case, right, price actually move higher. So we have this upward movement here where price move a little bit higher. Let me just give me a minute. Okay, so price move this higher here, goes higher. Now if you look down, or you can see that the MACD, which is a form of a momentum indicator, it's showing the opposite. So as price move higher, that means at the second attempt to be higher than the previous high, the MACD, which is a momentum indicator, is actually showing a downward movement, which means that the momentum doesn't catch up. It doesn't have enough energy. So this means that when bulls attempt to push the price higher, the second wave of bulls, they're actually very tired. They are not that strong as it seems. Okay, thus we have this concept of a bearish divergence, and then after a while, price starts to move down. Okay, now therefore, what can we understand about divergence here? If we are bullish, all right, and we like to buy, we can spot for some form of a divergence. Okay, so therefore, if we are bullish and we like to buy, we will spot for bullish divergence. All right, so to spot for bullish divergence, number one, we need to understand that when we want to buy, you want to buy low. So for bullish divergence, it means that price must make a new low, okay, and a new low. Now, when price attempted to make a new low, a low that's lower than the previous low, the indicator, which is showing momentum, is not agreeing. Okay, the indicator that's showing momentum is actually showing that at the second low, all right, a low lower than the previous low, the momentum is actually moving up. Okay, so when the bears attempted to push price lower than the previous low, no, it's not successful. The momentum indicator is saying that, hey, look, there's a lot of momentum. All right, a lot of people trying to buy in here, right, when price was again pushed lower. Okay, so when you have a bullish divergence, it means that price moved down. All right, the indicator can be MACD, can be any other indicator, is actually moving up. Okay, or the other way is that when price is flat, horizontal, okay, then the indicator is actually going higher, going up. Okay, so that is also another sign of a bullish divergence. Okay, now let's take a look at the bearish divergence. All right, bearish divergence will show that when price is moving higher, okay, move higher, all right, the indicator is actually moving lower. What it means is that in the second attempt for the bulls to push price higher, that group of bulls, they are losing strength. Okay, and we can see that from the indicator. All right, or if price goes flat, okay, then the indicator actually coming down. All right, so goes flat, coming down. So thus the earlier trade that we talk about, the divergence, all right, was fitting into the theory of a divergence. Right, so price move higher, the indicator, which is your MACD here, histogram here, the vertical bar is actually moving lower. So we have a bearish divergence here. All right. Okay. Now I'm just going to quickly cover the last method that I want to introduce. All right, and then to show you the video of how we use divergence to pick up really the lowest point of the SiMSCI trade, and that resulted in a huge profit for us. Okay, so the last method is what we call volatility trading, because many times that when price move, all right, it might be a reaction it might be a reaction to the overnight movement, or it might be that it moved to a certain level already. All right, let me cough for a while. I was too enthusiastic and I talked too fast. All right, so just All right, now, so we have the volatility trading. Okay, so what's the volatility trading? Just give me a minute. So we have, for example, that we can use the Bollinger Band to help us to understand whether price has moved to a certain range. Okay, so for example, at the top of the band, it means that price might be overstretched. So if price cannot sustain at the top of the band, we will be looking to sell it down as a form of method to trade, to let it resume to the mean. Okay, so this is a way of trading to resume to the mean, right? So for example, this particular trade, what happened was that there was a gap, and the gap hit right into a resistance, okay, into a high here, all right, and also at the top of the band. So the price wasn't able to sustain, okay, sustain that high price, and in fact, it came back down, all right. So you might want to put in indicators such as RSI or stochastic to detect the overbought and oversold situation. In this case, there was an overbought in the RSI. So RSI was also at the high, and it cannot stay at the top of the band, right? So that resulted in a sell and a short signal, and that was also a very nice trade here. Okay, so there are few methods. Mainly, number one, we can look at price action just purely on the breakout basis or the range trading. Number two, we can be trading with the trend, such as I highlighted. That would be the divergence trading, and lastly, we can trade the mean reversion. Okay, so these will be three main types of trading. All right, now what I like to do is I like to showcase the live trades of the SiMSCI, something that I did. Right, sometimes when we are doing lesson, we can't pinpoint to you, this is the trade opportunity or this is the trade. So I prefer to record that to let you see how we can do it. All right, and later I'll be going through the live so we can discuss about that later. Okay, so let me just share one of the trade that was done on the 2nd and the 3rd of November on the bullish trade, and especially this trade would let you know, all right, how to do a proper trade management. Trade management is very important, such as, for example, how to use the sheaf of your stop loss, okay, to keep on writing particularly a good trade. All right, so let me just share my another screen, which is this one here. All right, so that's the recording that I did, okay, and that's on the 2nd and the 3rd of November. I actually recorded something, right? So let me just narrate for you. Number one is that SiMSCI has been dropping, okay, and on the 2nd of November, 3:30, SiMSCI has been dropping, and then before, after it dropped for a while, it shows this green color bar. Okay, of course that we are not going to say that green color we are looking to buy, but we use some indicators such as the stochastic to help us to understand that it's actually at the low. Okay, but what I always like to do is that I always like to look at the higher time frame, which is the day, and then after that I will move to the 60-minute chart. So my entry are always done on the 60-minute chart or the 30-minute chart. Okay, so this happens to be a 60-minute chart. What I saw at that point of time was that when I drew in a horizontal line here, all right, so that's a horizontal line. Can you see that the indicator, which is the stochastic, is showing a bullish divergence? So horizontal, your stochastic is actually going up. Okay, so what I did is I show you, I talk about that this group of traders just use the first opening bar. Okay, so when price move above the first opening bar, they will buy. So I saw the bullish divergence. I saw that in a higher time frame, price was coming to a support. All right, and then price at this bar here move above the first opening bar, and that's where I bought in the SiMSCI contract at 276.3. Okay, so the price I bought in was 276.3. all right, and this trade managed to catch the low of SiMSCI before it bursts up. How did I manage this trade? I actually use the trailing stop. That means that I manually shift my stop loss to go nearer to the current price, okay, and to protect a lot of the profit. But very important, one of my style is I always will go to the higher time frame, which is the day, okay, the day time frame, to let me know one thing, all right, where can I take profit for this trade? Meaning that when I open a trade, I have a method, but I will always be looking at where I can take profit. So I identified that in this day chart here, there's a take profit level, and I waited, and the next day you can see that price moving up. Okay, it moved up to the place that I wanted to take profit, which is here. All right, so that's the place I wanted to take profit. And the question will always be that, you know, for traders like us, it's very difficult to get a good trade. Okay, a good trade that it can keep on going up, 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 or keep on going down, 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 down. Okay, so when we have this type of good trade and we had a good price already, I try to stay on this trade to make as much money as I can. So right now I have a dilemma. What's my dilemma here? All right, price is what is right now at a previous low that is acting as a ceiling. So my dilemma would be, should I continue to hold or should I not? So that's where I move into the lower time frame. All right, so what I did was that at 11:52 on the 3rd of November, all right, and then it's slightly before the first half of the trading session. All right, so what I did was that I actually shifted the stop loss, okay, to here. Okay, meaning that if you take a look here at this point here, I shifted the stop loss to somewhere around here. All right, this is one of the low. All right, after price reached the low, then it managed to move up. Okay, so instead of taking profit at a suspected resistance, because this is a very good trade already, what I did is that I shifted the stop loss to protect my profit, so that if price is to come down, I will just exit this position with zero loss. If price is to continue to move up, then I can continue to get a lot more of profit from this particular trade. Okay, so you can see that end of the day, let me just show you, end of the day, all right, price kept moving up beyond my original target, but I didn't exit the trade. What I did was I kept shifting the stop loss. When price was here, I shifted the stop loss to 280.25. So this is a way of manually trailing your stop loss to protect your profit, and so they can maximize your trade here. Okay, all right, so let me just come back again into my slide here. Just want to do a bit of a revision. All right, so just to come back into my slide, and just give me a minute. Okay, here's my slide. Okay, now a question to you guys. You know, just now we traded the SiMSCI contract. You show you the live trade. So if I were to go long, okay, if I were to go long, would I be buying at the bid or the ask price? You know, if you know the answer, you can just type at the short question or the chat. Let me know your answer. If I were to go long for the SiMSCI contract, would I be trading at the bid or the ask price? Okay. Anybody has any response? Yeah. Okay. You will be trading at the ask price. Okay. Remember, when you go long, you will always be buying at the higher price. So therefore, you will always be trading at the ask price. Okay. So what happened was that when I look at these quote here, all right, I clicked the ask button. I bought into the SiMSCI contract. So the price that I bought was at 276.3. Okay. Now, if I were to square, that means to close my position, all right, then based on the next quote here, 293.45, 293.50, if I were to square my long contract, where would I be trading? I'll be trading at the bid or the ask price. Any response? If I were to square my long contract, right? So which side would I be trading? Is it bid or is it ask? You can let me know your response in the chat box or in the question. Okay, yes. All right, so that's the bid side. So remember, if I want to buy, I always have to transact that at the ask side. Okay, if I want to sell, okay, that means to square my contract, I need to sell, right? I will always be doing that at the bid side. Now this goes the same when you are placing a limit order, limit to queue. All right. So what happens is that when price touches your particular limit order, it will move into a market order. So it will still be back into the bid and the ask. Okay. Right. So for example, when I traded this contract, my open price, the entry price was 276. My close price was 293.45. So I made about 17.15. How do I do that? I keep shifting my stop loss. All right. Until the point where price hit my stop loss and I exited. Okay. So if you recap, if per point movement is 100, then the estimated profit for this trade on the one contract will be 1715. Okay, so if you take 1715 divide by the margin required, so that will be about 78% profit. So this is one of the reasons why people are interested to trade the SiMSCI futures. Okay, because then that percentage return can be very high. Okay, because then you are talking about margin. Now, just the reverse, it also means that you can lose this amount as well. Okay, so this percentage as well, because if you can make the profit, you can lose that equal percentage as well. Okay, so it's not only about profit, it's also about losses. Okay, now what I also like to do is I like to go into the live chart here to talk about the use of divergence and Fibonacci. Okay, just to illustrate to you what we are seeing right now. Okay, so I'll be going to my Chrome. Okay, just give me a minute. Okay. All right, so let me just go to my Chrome. So here you go. Okay, now you will be seeing futures chart right now, SiMSCI MSCI futures chart, and right now is a live movement. That means it's ticking. Okay. All right, so what I like to always do is I always like to go to the day. So this is a day chart. Okay, so this is a day chart. All right, and then I will use the day as a clue for me to trade, and my execution will always be in the lower time frame. So you can choose 1 hour 60-minute chart, or if you want, you can go into a 30-minute chart. So let me just illustrate on a 60-minute chart. Okay, so let me just go back into the 60-minute chart. All right, now if you take a look at currently what's happening, okay, so there was a drop. Okay, so there was a drop when the market opened. Okay, the question will be back to you again, right? Are there any sign of this drop? Just now we talk about divergence. Okay, so if you can see this is a high that's being made, right? Okay, how do you know this is a high? You can switch that into a line chart. So this is a high. Okay, and then this will be another one more high. All right, so let me just put back. Okay, so this was the high, and then this is another high. Can you see that as price starts to move higher like this? Okay, now look down to the indicator. Look down. Okay, you can see that the MACD indicator, what is it showing? It is actually showing a bearish divergence. Can see that? So as price move higher, all right, your MACD is showing a bearish divergence. It says that as price was being pushed up to the second high, it wasn't able to sustain. Okay, it can't sustain because the momentum is not there. Momentum is not agreeing with price. Thus, okay, price in the morning when it opened and it closed below a certain level, when it opened already at the first opening bar here, it's actually moved down. So that becomes a sell opportunity. Okay, so that's one of a very simplified trade you can do, if you are trading the SiMSCI in this morning, right? So definitely there will be a lot of divergence going on. So for example, if I were to look at this place here, somewhere around here, can you see that price actually moved lower? Okay, so this is a lower. Now look down to the histogram here. So look down to the histogram. Can you see that it's actually going higher? Okay, so that's another form of divergence here. Okay, that's a bullish divergence, right? Now another one, when price move lower, okay, all right, then you can see that there's this divergence going on, that this one is blocking me. So let me just shift a little bit. You can see that that's actually the histogram that shows a higher price. Okay, so that's also a bullish divergence. All right, so we can use the divergence as a clue to let us know that the momentum is actually winding down. All right, so same thing, somewhere around here. Okay, price goes flat. For example, price goes flat. All right, then the MACD and both the histogram is showing a bullish divergence. You see that? So that's a bullish divergence here. Okay, so of course that we can apply the bearish divergence. So that's one way of looking at price. But again, all right, not only that we check into the divergence, we also must make sure that it is at a very strong level. So for example, if you want to use this as a form of, let's say, bullish divergence, we can draw in things such as Fibonacci. From here to here, price is at a 62% to 76% retracement level. Okay, so that's a very strong level, for example. Okay, so same thing from at around this place here, that's also a 62% to 76% retracement level here. So we can use all these tools to help us, okay, to complement the use of bullish divergence, all right, and with a certain level, and then we can put in a trigger. Okay, so these are some of the live illustration that you can consider to trade into the SiMSCI. So right now, very important, let's say for example, if you think that SiMSCI is potentially going up, okay, so let me just clean away this one. If you think that SiMSCI is potentially going up, so what can you do then? Number one, you can say, hey, look, this was an upward momentum, upward movement here. I can draw a Fibonacci retracement from the low to the high. Let me just wait for price to come down to this zone here. Okay, so when price come down to this zone here, right, what do you need? You need to have, let's say, a show of the momentum. So perhaps that you need to see some bullish divergence, okay, when it's again coming to the low side here to make a buy. Okay, so all these are potential way for you to trade into the SiMSCI, okay, just by using divergence analysis. Okay, all right. Now let me just show back my PowerPoint. Okay. All right. So let me do a summary of what I've just shared with you guys. Number one, if you want to swing trade, okay, then there is a need for multiple time frame analysis. All right. So multiple time frame analysis means that you need to refer to one time frame, which is the higher time frame, and then you need to refer to a lower time frame. So I suggest that the higher time frame will be for the day. All right, the lower time frame for entry and exit can be a 60-minute or 30-minute chart. All right, it is better for you to focus on the slightly higher time frame. So instead of going to the 5-minute, right, it is better for you to try the 60-minute or the 30-minute chart when you are new to trading. So this would be less noise. You are likely to get less chance of being spiked out for all these very short-term movement. Okay. A lot of people ask me, you want to trade, can you really make money? End of the day, there are many factors, okay, whether you make money or not, right? So and it's also a long journey, but if you can do it properly, you can make the money, okay? But more important is that when you are starting to trade, be realistic. Realistic means that, for example, don't keep on thinking about how much I can make. All right, do also think about how much losses I can have. All right, I might have. All right, so focus on your goals. Your first goal might be, I want to start off small. All right, I want to be consistent in terms of being profitable for a month. Okay, then after that I can slightly increase my volume and then and be consistent for another 3 more months, something like that. All right, more important, when you are really trading, and you are trading for income, for example, do cover your downside. That means you have some form of a recurring income or some form of a income, so that you don't need to keep on worrying. Don't need to keep on worrying that you need to make money every day. It can be really, really very stressful. All right. Okay. Now, lastly, something that is really for me to ensure that you have a winning career, meaning that you have a good chance of winning, right? Number one is that you need to have a comfortable strategy. Why do I say it's a comfortable strategy, not a good strategy? Because some strategies, like a group of my friends, all right, they are like scalping, and every time 2-3 ticks and 100 contracts. You know, they are comfortable with that. But for me, when I look at 100 contract and then 2-3 ticks and look at the amount, right, I faint. Really, that's too much for me, for example. So you need to have a comfortable strategy so that it can be profitable for a long time. Okay. And if you are working, or you have a day job, or you have a schedule to follow, just make sure that that strategy or that trigger can fit your schedule. Why do I say that? Because it's not that we can't find profitable trade. It's just that when that profitable trade comes in, all right, and you need to put in the trade, right, you are not around at the right time. Okay, when you're not around at the right time, it can be very tough. Okay, and very important, for every trade, you need to have a stop loss. You need to have a profit target. A stop loss, sometimes you might not want to put it in, all right? You might have a mental stop loss. That's fine, but at least you have something to limit your possible potential losses, okay? And then to have a target profit, all right? And more important is to make sure that you have a healthy margin, all right? You know, if the brokers require a margin of 2005, don't just put 2005 inside, because you will get into margin call easily. Okay, make sure you have enough margin as a buffer. Then people ask me, then how much do you recommend? I recommend that to every contract of SiMSCI, it is important to have at least minimum 100% margin buffer. This means that, for example, if the margin requirement is 2005, please make sure you have 100%, which means that at least minimum 5,000 inside your account first to open one SiMSCI contract. And even a 100% margin is really like minimum. Okay, it's good to have more. Okay, all right. Now I come to the end of the session. I just want to know whether you guys have any questions. All right. Yes, I have one question here. Let me just, okay. Can you repeat again one question? How to decide the trade by looking in day first and then the lower time frame? All right, so let me just go to my, the platform. Okay, just give me a while. Okay, here you go. All right, now I'm back into my platform right now. Okay, let's talk about the days first. Okay, I'm just gonna clean away everything. All right, so this is the day. Number one, from the day we know that SiMSCI is actually trending higher. It's actually in an uptrend. Okay, so we are interested to buy when it comes to a strong level. Interested to buy. All right, so from what is happening right now, okay, what is happening right now? It is at a support. Okay, so I'm just going to draw in a horizontal level here. So that's support. Okay, so this is support level, right? So what I also like to do is I like to refer further. Further means that, I like to see a lot more, and I can see that the support that I've drawn in was also a previous high here. Okay, so that's a previous high. So the best place to buy into SiMSCI will be somewhere around here at 319, 320. Okay, so that's number one. Now, number two, what I can also see is that this is today, right? So yesterday, price had also closed above some of the highs here. Can you see some of the highs here? So what I'm going to do is I'm just going to draw in a horizontal level here. Okay, and then this horizontal level, I'm just going to mark it differently, and to make sure I have a thick line. Okay, so now because of that, it closed above the previous high. I have to assume that it broke above some support, some resistance already. So coming back, all right, if the second lower line, it doesn't come to it and price gets supported here and there's sign for me to buy, I'd be interested to be looking to buy somewhere around here. Okay, so that's the price that I'm aiming for. All right, so I switch to the hourly chart, and then indeed that price stopped somewhere around the level that I marked. Okay, today it stopped. All right, but it doesn't there's no signal for me to consider very strongly. Right, if I were to just use the divergence signal, I need to see a divergence coming inside from the MACD. Okay, so thus price would have to move down. So for example, what I can envision is that price might potentially be moving down in a correction manner, correction wave. So for example, you move down like this, all right, move lower here, okay, into near to this range. So this is a very typical Elliott wave movement. You know, when you look at prices, prices will just move in this down, up, down manner many times. I can just illustrate that to you. For example, you see, down, up, down. Okay, so it moves like this. Okay, even at this place here, the big down, up, down, big one, down, up, down. Okay, and a small one. Okay, and that's why the divergence is very useful for us, because once we can spot all these movement here, the down, up, down, then we can use the divergence to help us. Okay, for example, you see, every movement will have this type of movement here, right? So essentially, there's a support here. I'm waiting for price to move down again because I want to buy low, and I will be looking at a bullish divergence somewhere around here if price ever move down again. Okay, so if there's a bullish divergence, price move down lower or maybe the same low, and then there's a trigger, then I'll be using that as a chance to buy. Okay, so that's how I use the higher time frame, and then how I use the lower time frame to formulate my trade. All right, so let me see whether you have other questions. Let me know whether you have other questions. I can answer your question. Okay, there's some question here. Do we need to trade every day? No, I don't trade every day, but I trade many instruments. Okay, I trade the forex. I will do also the gold, the oil. I also do Hong Kong equities. I also do SiMSCI. So whenever there's a very good setup, okay, there's a good reason, then I will trade. So for example, in fact, that at around this place here, okay, at around this place here, this one, I was looking for a buy here. Okay, in fact, that I mean, I actually bought in earlier. I bought in at this bar. Okay, this one. Okay, then it came down a little bit. It didn't touch my stop loss, and after that, it gap up, and that's where the trade turns into a profit. So I don't trade the SiMSCI every day. I only trade when it comes into a very good patterns, such as it shows a bullish divergence for me to buy, or bearish divergence for me to sell. Okay, and of course that there are other in comparison, not only the bullish divergence, I also use all these method to help me: support, resistance, Fibonacci ratios, and then wave. So for example, there's a Fibonacci ratio here. From the low to the high, you can see entered into a very nice Fibonacci zone, which is the 62% to the 76%. Okay, so that gives me a lot of reason to buy, because you're not buying at the high, you're buying at the low. All right, how low? If we trace by 60 to 70% with a bullish divergence. Okay, so you don't need to trade every day. All right. Okay, the next question. Please elaborate on the free charting platform you wanted to refer to. This is the free charting platform. It's called investing.com. All right. This is the free charting platform. But if you like, you can open an account with Phillip Futures, for example. Once you open an account, perhaps that stream I want to answer the question later on, whether we need the funding. I don't think we need to fund immediately. All right, then you have the charting platform as well. Okay, if you need a link to this platform here, this one, let me just send you guys the link via chat. Okay, so this is the chat here. All right, I'm sending you the link. You can copy that. Okay, go to the chat tab, right, and then you'll be able to access the link. I'm not able to view the SiMSCI in the poems. Is that I need to use the Phillip futures? Yes, you need to use the Phillip's futures. Therefore, later I will flash to you where to get the demo account. All right. Okay. In the MACD divergence, we can use either the histogram or the signal to draw the divergence line. Yes. When both happens, the better. If only one happen, also good enough. Okay. Most important, do look out for this zigzag manner here, zigzag pattern here, down, up, pattern for buy, or up, down, up pattern for sell, right? So you want this type of a zigzag pattern here, which is essentially an Elliott wave correction pattern, all right? And then you need a good level, such as the Fibonacci retracement level, and then you spot for the divergence, either using the histogram or either using the MACD or both. If both happens, that will be good. Is the SiMSCI contract active? Yes, it's very active. And you don't need to worry about liquidity, because then the counterparty is the exchange. All right. When the counterparty is exchanged, then definitely someone will be there to buy from you. Okay. What is the daily average volume or OI? It varies. All right. So you can check that from the SGX website, SGX Futures website. But you will be less active during the off hours. That means that during the T+1 hours. Okay, so right now it's less active. TAS, you can see, for example, right now, right, it's not really moving very much. Okay, it's just waiting for number one, the US hours to open, right, and then SiMSCI will move according. Not all the time. Okay, most of the time you will move according to the US market. All right, so you can also trade that as well. Okay, let me see whether there's any other question. Is SiMSCI round the clock? No, it's almost round the clock. In my slide, there's this cash trading hours that's 8:20. That means the actual trading hour starts at 8:30 to 5:20. Okay, 8:30 in the morning to 5:20 in the afternoon. After that, it will rest for a while, and it starts again at 5:50 and ends at 5:15. So it's about 23 hours. All right. So it's not round the clock, but it's near to round the clock. Okay. Now, since there are no more questions, let me just quickly flash the place to get the demo. Okay. You can go and get the demo, then so that can, yes, here you go. You can't use the Phillip yeah, I think this is a platform for you to get the demo. All right, so Phillip Nova, so you can scan here to get the demo. To get the demo account is free of charge. I think I will pass to Sri. Perhaps you can answer the question. I forgot already. Ethan told me about that. Whether we need to open an account, whether you need to fund first to how to say, to access all those features. Sri, back to you.
Hey Billy, thank you so much. Yes, you can request a demo to view the charts, and for some contracts for the demo account, we've got some contracts including the SiMSCI. So you might want to request a demo to try it out and get a first-hand view of the Phillip Nova demo. The platform is highly mobile responsive, so it's a web browser-based platform. We also have a mobile app, so there's added convenience for you. So just request a demo and give it a try.
Do they need to fund first in order to access the full features?
The free demo, you can have a feel for the platform. You'll not be able to place a trade that goes through, of course. But then you'll be able to have a feel of the charting, the platform, and look at the various features that the platform comes with.
But if they were to open an account, and do they need to fund to access the full features?
Of course, if you want to place a trade and actively trade, you need to fund the account to fully activate.
Okay.
But to try it out, you don't need to fund. Okay, so feel free to request a demo.
Okay, so to try for the demo is free of charge. You can have a look at the charts as well as how the platform works. Okay. All right. Any other last question that either me or Sri can answer. Let me just check that. Otherwise, we're gonna end this session. Okay, there's few. Which time is more active for the SiMSCI? Cash index, cash trading hours. That means at 8:30. 8:30 when it starts is active already, all right? And then till 5:20. So about when the cash starts to end about 5, the volume will start to wither down a little bit. Okay. What is MT5 or Nova? Which one must select? I think Sri, to get the Phillip's futures for the SiMSCI is to use the Nova, right, Sri?
Yes, Vinny, for futures trading is the Nova platform. But if you're
Yes.
gonna have a feel of our Forex platform, you can try our MT5 platform.
Yeah, so for futures trading is the Nova platform. Okay. All right. Thanks a lot for joining the session. It's nice to have you here, and then it's moving towards holiday already. So happy holiday, and see you guys again. For myself, I see you guys again 2021. All right. So back to you, Sri.
All right, thank you so much, Vinny, and thank you for being a wonderful audience with so many engaging questions as well. If you have more questions, please type them down in the survey form when we end the webinar. If you have any feedback that you want to share as well, please feel free to do so. Until we see you for our next live webinar, stay safe and have a wonderful festive holiday coming up. All right, goodbye, everybody.